what happened in China with the mining going offline. I think the thing that people paid more attention to was we had a bit of a flash crash, if you will, this weekend, right, where we had about a 15% decline in half an hour. And as we tape today on April 22nd, we're trading, at 54,000 or so, down from, a high of 63,000. Can you talk about sort of that decline, what you think triggered it? I'd be curious what your insights are.
Sure. We were trading in sort of the high range of 60 to 62,000 like a few weeks ago, and it was trading at a near all-time high. And whenever we're at an all-time high, traders like to go long because there's no resistance overhead. And the whole market was very highly leveraged. There was more open interest contracts in the derivative markets than we've seen any time in this year. And so when you're in a situation where the market's highly levered, it's very emotional. And so what happened in China was there was a power sort of outage. The Chinese power companies were undergoing a safety inspection. And so it looked like the miners in China, which some estimates are between 25 and 40% of the mining power on the Bitcoin network is located in this particular area. These miners went offline, and they went offline at a very critical point. Because essentially the Bitcoin network balances, the amount of hash power these miners throw at the network with a difficulty adjustment. So this sort of keeps everything in check. So our block times keep being processed every 10 minutes. And so the difficulty just went up, and within something like 12 hours of that difficulty adjustment, the miners went offline in that part of China. So we had a reduction of compute power thrown at the network just at a time when we needed it adjusted for this higher amount of compute that is normally thrown at it. So immediately the network started to slow down. The amount of mining, the compute, was not sufficient to balance off the difficulty, and so block time started to slow down. And you can imagine if hash power starts to drop out of the network, and there's always been this correlation between hash power and price. We're in this highly levered zone, and speculators sold off, and so it was a sell-off that was quite unprecedented for this year, in that nearly 5 billion contracts got liquidated. 1 million accounts were liquidated across the whole ecosystem. If you were to include the entire crypto asset space, it was nearly $10 billion of liquidation. So we had a big flash crash.
So, if I can put that in layman's terms, is what we really have is, right, we have people who are levered, right, 20 to 100 to 1, right, and as the price starts falling, right, you have people that get sold out, and that puts pressure on the market, which then sells out more people, right, and then you get this sort of cascading effect. Is that really that's the dynamic you're describing, right?
Exactly. It's we call it a long squeeze. Either if you're trading on leverage, you're essentially buying assets with money you don't have, and so liquidation is essentially the bank foreclosing on you. So when that happens, your entire positions get sold, and that's dumped onto the market, and obviously that pushes the price down. And then it sort of cascades to the people below you with their risk limits set a little bit below, and it just creates this chain reaction, and the whole thing starts collapsing until everyone's liquidated, and then the price bounces back up. So
we do a weekly Bitcoin show because there's just so much news in Bitcoin. And one of the things someone asked yesterday was, how is the market different today than it was in 18? And the answer I gave, which I'd be curious to your reaction and tie it back to this, is in 18, it seemed like everyone was speculating. People, right, were buying Bitcoin to sell it at another price to make money to go buy stuff with, right? This sort of idea of hodling or being like an investor, I think really hadn't taken hold. And I can tell you as an institutional investor, we own, $600 million or so of Bitcoin. We're investors, right? We haven't sold any Bitcoin, right? We deal with the ups and downs. But it does seem that there's still and I don't know what percentage of the market, right, is composed of speculators, right? And price action tends to be driven by the marginal buyer or seller. I guess I just like your reaction to the market composition today versus what it used to be. And, again, is it speculators that are driving the market, or is it this institutional adoption that we're seeing?
Yeah, the market's completely different from 2018. 2018 was a bear market, right? So that's
I'm sorry. So 2017. I mean, when I say that.
2017 was, Bitcoin had a lot of exchange activity, but very little of it was levered. We didn't have well-developed futures markets. The leverage you could get was on margin, so borrowing rather than derivatives. And so the price was less. I would say it's less levered. But I'd say also right now, we've got this very large dominant derivatives market, I'm just looking here. The normally derivatives market was much higher than spot, sometimes 5 to 10 times higher. We've just flushed out a lot of the derivative traders. So even now, post that flush, the derivative volume is 50% higher than what we're seeing on spot volume. I would say, you might think that the derivative market has a lot of price control over Bitcoin, but actually that's not entirely true. It has a very short-term dominance, because if you're going to buy Bitcoin on margin, or you're there for whatever you buy, you're going to have to sell out sooner or later because it's a short-term trade. And so ultimately, what's really important in this market is the long-term investors who are coming in to buy and hold. Whether they're coming in to buy and accumulate, or whether they're selling, ultimately, when we're looking into the weeks and months ahead, that's going to determine the price of Bitcoin. Essentially, the demand and supply that's dominated by the long-term investors. And this is what we're looking at on-chain. We can't actually see what's happening so much in terms of the trade positions on-chain. We can't see any of that. You have to look at data coming off the exchanges. But whatever happens in the short term, even if traders are shorting, and when you see long-term investors coming in to buy and accumulate, you'll know that it's going to be the traders that are going to get wrecked. They cannot continue to short and sell off into this demand that's coming from long-term investors.